Hello, I'm Andrew Winter, host of Selling Houses Australia, and welcome back to part 3 of Compare the Markets, Mortgages Made Simples. So, we've covered off character, how you make and spend money, and capacity, how much money you make and spend. Now let's talk capital, which means your deposit, what it can be made up of, and some of the ways you can give it a boost if it's not quite adequate. Your home loan deposit can be comprised of a few different elements, but let's start with the most fundamental and universal of the lot, your genuine savings. Yes, I know savings is such a chore, and saving up for a home deposit can seem daunting. The good news is that you don't actually need a full 20% deposit in the form of genuine savings. As much as your deposit can come from elsewhere, like cash gifts from your family or selling off other assets. But the bad news is that at the end of the day, you will need to have a decent chunk of change saved up, and saved up the hard way at that. As we've discussed at length, the lender will have an all-seeing bird's eye view of your finances that includes your saving habits. That means your lender will be on the hunt for evidence of both genuine savings and the habits needed to build these savings up. If you don't have them, you are less likely to be approved for a home loan. So save yourself up a nice little sum, maybe 5% of the total home loan value you're planning on applying for. This part is so non-negotiable, I really can't say it enough. You will not get a home loan as a first home buyer without a deposit. But I did say that savings don't have to make up the entirety of your deposit. So what else can you draw on to build up your deposit? Consider your current assets. Do you have some shares you could sell to give your deposit a quick boost? Gifts from parents are a classic too, aren't they? The bank of mum and dad. May not be an actual bank, but their money's just as good as yours in the eyes of the lender. That goes for cash gifts from any member of your family, be it an uncle, sister, grandma. Cash gifts from family are A-OK and frequently used by first home buyers. If your parents can't afford to give you cash, but they still want to help, you could consider asking them to go guarantor on your home loan. That way, instead of handing you cash, they are offering up equity that they've built up in their own home. Their equity gets stumped up as additional security against your home loan, and the value of the equity boosts your saved deposit. But if a family member goes guarantor for you and you can't meet your home loan repayments, your family member will be on the hook for however much your deposit they'd guaranteed. So just keep that one in mind before you go running off looking for a guarantor. The other biggies for any first home buyers struggling to build a deposit are the First Home Owners Grant and the First Home Guarantee. The First Homeowners Grant is handled at the state and territory level and is a cash sum given to eligible first home buyers. It's typically not something you'll be able to use to form part of your deposit though. It's usually paid after the loan has settled. Great for paying down a big chunk of your home loan early, but not so great for building a deposit. Now, if this is your first time buying a home and you don't know why that 20% benchmark is so important, it's because of two concepts: loan to value ratio and lender's mortgage insurance, or LVR and LMI for short. Let's start with LVR. Every home loan has a loan to value ratio, and it's simply an expression of how much your home is worth versus how much you owe. For example, if you borrow $500,000 for a home loan but offer up a $100,000 deposit, that's 20%, if maths isn't your strong suit. Your loan to value ratio will be 80%, as you've borrowed 80% of the property's value. LMI, on the other hand, is less universal. A lender will typically ask you to pay LMI if the LVR on your proposed home loan would be higher than 80%, meaning your deposit was less than 20% of the loan. It's not worth taking lightly. LMI can cost you thousands of dollars depending on your LVR and the size of your home loan. And it's not just for first home buyers either. If you refinance or take out a new home loan with less than 20% equity, you'll most likely have to pay LMI too. It can either be paid upfront as a lump sum, but is usually paid off over time via your home loan repayments. Something else worth mentioning while we're here, while you're crunching the numbers on your saved deposits, don't forget to account for your upfront expenses. Conveyancing services, stamp duty, building and pest inspections, these will all need to be paid for before your loan settles, which means a significant sum will need to come straight out of your pocket in the lead up to settlement day. So be prepared, don't let your planning be ruined by an overlooked expense, and make sure you know exactly what your costs will look like so you can factor them into your deposit calculations. That's another C done and dusted. We're really blowing through them now, aren't we? Remember, you can always revisit previous sections for a quick brush up if needed. We are covering a lot of ground here. No need to try and remember it all first time round. I'll see you next time for the fourth C, collateral.